Okay, let's answer some questions from the last market outlook. And I think I've seen just a couple of these, so most of these will be new as I get to them. You often mention that you target 20% yearly return. Let me correct that. I don't target anything. I target risk levels, and return will be what return will be. But I have a particular process, and I prefer a particular type of underlying, so that it has worked out rather consistently that I'm somewhere between 20-21% per year, but I'm not trying to get that. I'm trying to hit a certain type of risk profile, and that risk profile tends to return that. But I get what you're saying. At the same time, you forecast TLT in the 150 in 2026. That's a 25% annualized return without even playing the options. Do you believe you can beat that return, or just rather play the game than go on vacation for 2 years? Well, I'd never be 100% in one stock. In not that it's a stock, it's a portfolio of bonds, but I'd never be 100% in one single asset class, which is long-term bonds, right? To get that 25% per year assumes that I would be 100% in that, and that would be all. If I was going to do that, I wouldn't use TLT. I would use, if I was going to just go away, I would use zero coupon bonds maturing in 2041. That's gives me a duration of 17, same as TLT. I would never do that. So, sometimes you're in a stock that goes up 50-60%, but you never would have made it 100% of your portfolio. So you can't look at that and say, if only I did all of that. You'll only know after the fact. You never know before the fact. So that's why you never put all your money in just one stock, because you don't know. Nobody knows what it's going to do. Only after the fact is it, do people sit around and say, well, if you would have done this, if you would have done that, great. If you would have bet on this team, if you would have bet on that team, you would have won. If you would have held instead of called for another card, you would have won. If you had turned left instead of turned right, you wouldn't have hit the accident. But that's not the way life is played. Life is not played backwards. It's played looking forwards into an unknowable abyss. Now make your decisions. What do you do now, right? How do you determine your entry point for duration security? In your opinion, was prior 2 weeks good entry point for TLT? Well, so I don't know how to answer this, because to figure out an entry point is judgment. It's judgment on cumulative knowledge you've built up over years about what it is that you're making a play on. So it's not as if I was brand new to this and I have to figure out what's going on, and I have to do a deep assessment of all the variables that are involved to determine an entry point. I'm very familiar with the central bank, with yield curve dynamics, with bond pricing, with duration, with how TLT, being a pass-through security, produces its returns. I don't have to do a 2 week breakout and figure out all the variables to determine a price. I can at any point in time look at it and say, does it reflect the environment that I'm aware of at this point in time? And when you're scanning the news on the weekends or during the weeks, you know what to pay attention to. If you're long GM and you're scanning the headlines and you see something about GM, you read it. So week by week, you have cumulative knowledge that builds up on all the other knowledge. So at any point in time, you've already done all the work, right? So it's to answer, how do you determine an entry point? If you know nothing about something, it'll take you 2 to 3 weeks to figure it out if you're going to do it right. But if you know something about it, well, then you'll have a feel for what it's going to be. That's about the best answer that I can give you. Could you try to explain how market probabilities for Fed rate cuts are calculated? I did read the reply. You have a link to the methodology there. 3 questions. You said you'd be willing to take a position in house construction companies. Is this due to rate cutting cycle we are in? Along with, it's mostly because there is an undersupply of housing in the U.S. and it will be undersupplied for years to come. So demand for housing will be robust for years to come. That's mostly why. In some specialized newspaper, I read that positive performance of XLU are already the result of AI hype, and weak performance may lie ahead. No, this is a possibility of anything, anytime, anywhere, right? Is to say that this is what drove the price. And usually if the price goes up, there's some driver for it. There's some story that causes it to go up. And somebody somewhere will always say it's pretty much played out. You have to make that assessment for yourself. Right now in the US, AI uses 1% of all the energy produced. AI is concentrated in a few states. And in the states they're concentrated in, they're about 10%. And AI companies, especially the large companies, are looking for utility companies to provide them a single source of supply, primarily through nuclear. If you believe this is over, you must believe the AI thing is pretty much done. There's no more build out. What is being built is what's built, and that's it. We're pretty much not going that much higher. Utility companies don't trade for 30, 40, 50 times earnings. Rarely will that happen. So will utility companies need to add assets? If the answer is yes, then the revenues go up. That's how the regulator calculates it. You're going to have to add assets. Great. We agree with those assets. Your return is based on the level of assets, and that's just how it's calculated. So they're guaranteed the return based on the size of the assets. You again have to decide for yourself what side of that story you believe. There is no answer. There is no solution. There's no formula that you could break out and say, aha, here's the solution. It's, well, what do you think? That's what makes a market. Some people think, well, it's pretty much all priced in. There's not a lot of upside from here. Others say, no, this is a decade-long build-out or a multi-year build-out. This is not over yet. Others say, it's not just AI. You're forgetting about the whole transformation of the grid towards green energy. That has to be built out, which means assets have to be added. Assets were going to be added to utilities at the rate of 6 to 7% for the next 10 years, even before AI. So you have to, there is no answer. I don't know. I imagine that's an unsatisfying answer, that there is no answer, but that's simply the truth of complex social systems. Is there's never an answer. There's only what you believe. And the future will play out in such a way that your belief will either be right or it will be wrong. That's it. You're playing an unknowable future based on the best information that you have at this time. If you outsource your thinking, so this person says, oh, it's all played out. You may read another one that says, no, it's not played out. If you outsource your thinking, what you're doing is you're imbuing the writer of that article with more vision about the future than they have. They don't know. It's just their opinion, right? So you have to add it in with what else you know. Still on XLU, part of the technological improvement, as you said, is to make things cheaper. Does that apply to electric consumption from AI companies as well? Maybe in the future as they become more and more efficient in running their algorithms? Not really. For example, NVIDIA's Blackwell, their new GPU, takes significantly more energy. There is no energy savings here. If you want to go from 1 trillion calculations a second to 10 trillion calculations a second, you got to move bits and bytes around. That takes energy. It simply just takes more energy. All you can do is find a more efficient energy source. let's see. Following up my question, 30K portfolio value, 80% invested in 60/40. Okay, so 20%, 6,000 cash. Contribution plan, 1,500 per month. Okay. 2 hours education plan with your applied series each day. Now I'm running a 10/20 delta theta portfolio. Okay. 30 theta decay per day. Okay. Is this strategy running 60/40 and income factory all right? Yeah. For a beginner, yeah. Yeah. Just try to pick your underlyings in such a way that you're not getting greedy, right? I mean, if all your underlyings are, Teslas, Nvidias, CrowdStrikes, if the market turns down, they turn down hard. And you can get crushed, especially if you don't have the money to buy the underlying. You have no choice but to take a loss. So choose your underlyings carefully. Yeah, but yeah, asymmetric, synthetic, an asymmetric synthetic. It wouldn't be a synthetic. Synthetic long TLT January 26. Long, I'll call it 100. Short, I'll put it 94. That's not a synthetic. That's a risk reversal. Can't picture a scenario with TLT under 100 in a year. Maybe it's just me, but duration makes so much sense now. Yeah. Already long TLT 25-year bonds and strips, but looking for some additional boost. Careful about getting too much into one factor. No matter how right you think you are, I would still I'd still have diversification. I wouldn't load up all on duration. I have a lot of duration, but I also have a lot of equity, and I also have a lot of cash. And I'm more cautious about adding duration now. If TLT, pulls back to 94 and 93, I will add more at that point. But I'd be careful about, going too far in. Where did you find the debt bubble visualization? It was in a story on Apple News, pretty much where I get everything. Repo section of the Market Outlook. To my understanding, when looking at New York Fed's website, the reverse repo is saying that the Fed is accepting cash in return for securities such as treasuries. Yeah. Which makes me question why business would do this. Because it targets a rate. What it does not want money market mutual funds to do is to take all the extra cash they have and go in the open market and look for securities, because they will drive down interest rates. They will drive rates down below the bottom threshold of the target range. So overnight rates, if their bottom is 4.75 and the Fed does not offer them 4.8, let's say, or 4.75, what money market mutual funds will do is go into the open market. Well, all that extra money, the other side is going to, with all that extra money going in, it's going to, that one would probably that would push up rates above, it would push up prices, which would push down yields. Sorry about that. So your yields would go below the bottom threshold. And the Fed doesn't want that. So to control that market, the Fed says, look, we will pay interest on reserves for banks, so your reserves don't have to go find a home in the open market, and we will pay the money market mutual funds a rate on overnight reverse repos. That's basically what it does. I think I answered all that, yeah. Just want to understand the risk reversal synthetic portfolio. 30-year-old who's working, I want to keep my portfolio simple. I'm thinking of doing a 70% XLK, 30% TLT. All right. So if owning them outright is better to do a synthetic. No. Because you got to keep rolling over the synthetic. And with the synthetic, when you buy ABC, you don't have a gain on ABC till you sell ABC. When you sell a put and buy a call, you immediately have a capital gain on ABC when you sell the put. That's a capital gain. 100% of that is a capital gain when you sell it. And then you have a capital loss when you buy it back at a lower price. That's the capital loss at that point. And you have a capital loss when you buy the call. So you do have a capital gain. It's tax inefficient because you have to keep rolling over that synthetic. Well, every time you roll it over, it's a disposition, and you're getting into a new security. So no, just buy the security itself, and then if you want to generate extra income, you can sell 10 delta calls on the security if you think that they're not going up that fast. Yeah, but I don't know that I would play around with synthetics unless there's some reason why you want to avoid the currency and avoid a withholding, like if it were in a different country. Given the hypotheses that the Fed would not be able to afford a recession based on the decreased tax revenues received and their need to service the national debt, would a reignition of inflation not only be possible? Anything is possible in complexity. So again, social systems are complex, economic systems are complex, which means anything is possible. And would be not only possible, but even wanted by the Fed in order to help inflate the debt away. The Fed's not concerned about the debt. The Fed's concerned about the economy. It has full employment and price stability. If the debt levels and the interest payments begin to affect economic performance because the government has to pull so much out of the economy in taxes just to keep the debt alive. If that's the case, then the Fed will lower rates to maintain economic activity. The Fed is not interested in the debt. That's the Treasury and Congress. The Fed has no interest in the debt at all. Only the health of the economy. Would this not result in a higher terminal rate? The terminal rate, let's be careful when we use the word terminal rate. Terminal rate is a rate at which we would arrive at the end of some period. So when we talk about the terminal rate at the end of 2025, it's where we think rates will be at the end of 2025. What's the terminal rate for 2024? Meaning what rate will it be at the end of 2024? So the terminal rate you can't talk about unless you give me a date. I think you mean the neutral rate. The neutral rate is a rate at which the level of rates neither cause inflation nor deflation. That is a very proud statement today. That may have been true 50, 60 years ago when the world was much smaller and money in the US had very few options of where to go, where production in the US had very few options of where to go. Like if you go back to the 50s, you're pretty much an American-centric model. You're not doing business with the USSR. You're not doing much with South America. You're not doing much with China. China's really not even there. India's not even there. You've got Europe in the 50s. It was in a rebuilding mode. You're not doing much there. It was pretty much a US-centric market, which means money had to respond to the cost of capital in its own space. That's no longer true. That what drives the level of inflation now is technology more than anything else. So the interest rate is a remnant, a relic. I don't believe that you're going to have a neutral. If you think about the neutral rate in terms of the interest rate, it can be any rate, and I don't think it's going to affect much. I think the amount of supply and the pace of technology is going to do everything, and that's deflationary. So I would move away from thinking about where the neutral rate is, because you're giving way too much credit to one single interest rate in a global economy where money is mobile and money can go anywhere and everywhere, and people have the ability to immunize themselves in many cases from interest rates. I don't know that the interest rate is responsible for the level of inflation. I think it is supply. So the Fed raised rates, and you could say, well, they raised rates and inflation came down. No. Employment increased and inflation came down. Because if you have more people working, you have more output, you have more supply. Supply increased and inflation came down, despite the interest rate hike. And supply is still increasing and inflation will come down despite the cuts in interest rates. So, yeah, I think we need to move away from discussions of how the interest rate affects inflation. I don't think it does. IB shows unrealized P&L for covered calls. Excuse me. This will depend on how you set up IB. Have you set it up to use the bid price, the offer price? So you can set it up such that if you're long, it'll show you your unrealized gain, not based on the closing price, but based on the bid price, because that's the price you have to exit at. It's called the liquidation price. You can select it to be in the middle part of the range, or you can select it to be in the offer price. So, you may have a different setup. I bought 100 shares of FCX at 40, sold $50 call, premium of 4. Stock rises to 70, IB shows an unrealized loss of 16. However, if the option is exercised, I'd sell the shares at 50, 25% profit, plus the premium. IB showing this is an unrealized loss because of the opportunity cost of not selling at 70. And is closing the option the only... What? I'm not following this. You bought it at 40, you sell it at 50, you'll have a $10 gain. It gets called away from you at 50, you get the $4 for the option, plain and simple. That's all it's doing. So I'm not following. If it's called away, how do you still have an unrealized loss? I don't understand that. No, I can't follow your example. I'll pass on that. Since the shares will be sold at the strike price, does unrealized P&L really matter? Well, you're looking at one thing for the unrealized P&L. If it's at $70 and you sold the call at 50, you bought it at 40, you have 100 shares, you'll have a $3,000 gain on FCX and you'll have a negative $1,600 loss. This is a pair, right? You can't just look at one and say, why is it showing negative 16? Well, because it is. If you close it out right then and there, you'd lose 1,600 on it, right? So you got to look at the combination of the two. There's your 14. Does the unrealized P&L for covered calls impact my cash? Yeah. Yeah. Options are marked to market. So all gains and losses are settled up every day. All derivatives are marked to market every single day. So if you're down 1,600, that cash has already left your portfolio. Already left. How geopolitics can cause a global U.S. recession? Oh, that's not a coffee time answer where I could just say, well, it's this and that. That's a seminar. Is it mainly due to the rise of oil prices? It could be from anything. Anything significant enough that causes a pullback in economic activity somewhere, or stress in a market somewhere that has a contagion effect. And that's just one thing. I mean, that's a seminar that you're asking for. 5-6 hour seminar, easy on that one. So I'll pass on that. I'm usually an equity investor, but won't expose myself to duration. I expect long-term rates to fall. XLU would usually seem like a substitute for TLT. However, in the last month, XLU rallied significantly while TLT was rather flat. True? Would you consider XLU overdone? I don't know. I still have it. I'm aware of the growth story around utilities, but I wonder how much I can benefit. if utilities finance their expansion primarily through capital increase, thereby dilute existing shareholders. Well, that is the case, but they do get their cost of capital. So they do tend to increase their dividends over time, which means their share prices tend to increase over time. But yeah, they've had a great run, like 30-40% this year alone. Rare for utilities, but it's a confluence of a few things happening at the same time: aging infrastructure, a decarbonization of the grid, expanding population, new subdivisions, AI. More and more of the world will be digital going forward, not less, but more will be digital. That requires electrons, that requires utilities. Is it overdone? I don't know. Nobody knows. I know you're probably getting tired of hearing me say that again and again and again, but that's the answer. Nobody knows. You have to use your judgment based on everything you know. Do you think it's overdone? Right? They've had a good run, but the market's had a good run, and it just keeps going up every day. Good news, market goes up. No news, market goes up. Bad news, market goes up. So is it overdone? If you say, I've been saying that it's a little overextended for well over a year. Said another way, I've been saying it's overextended for the last 1,000 points. And doesn't matter. Some stocks are trading at 80, 90, 100 times forward earnings. They go up. MicroStrategy hits an all-time high while Bitcoin drops in price. And if all those holders, if they convert, in fact, some of them won't even convert, it'll just be straight debt. That on a book value basis, it's not worth that. Anybody with a little bit of math skill can tell you it's not worth that, but it goes up. Is it overdone? I don't know. Overdone stocks can become even more overdone. Underdone stocks can drop even more in price, and some just get ignored altogether. So, if you're looking, and I was going to put something in the applied level on social momentum, because there is price momentum, which is, just looking for 52-week high stocks, and then there's social momentum. For that, you need a crowd, and you need a story. You need a story with buzzwords. And right now, the buzzwords are AI. Right? And once everybody starts talking about something, prices can go to ridiculous levels, and everyone is AI. And this story is not over. NVIDIA's new Blackwell, demand is insane, off the charts, they say. Super micro computers, their latest news about how much they're shipping, off the charts. The utilities saying how much, energy data centers are taking, and all of this talk about new nuclear is off the chart. You have this going on, you're going to get the sheep. And the sheep don't think. The sheep just herd. That's all they do, is they herd. And you're going to get the sheep. So utilities have a sheep following, because it is being placed as a way to play the AI trade. So if AI is alive, utilities are alive. When something is overextended, you just got to have faith that the crowd will not question it. And sometimes the play is the crowd, not the price, not the stock, not the fundamentals, but the crowd. That's called social momentum. If you want to find good targets for social momentum, use Google. And for certain keywords, you can look at how popular that word is in searches. It gives you a little chart about how popular the word is in searches. Search for utilities and have a look at it, at how often it's searched for. And if you see the chart just climbing and climbing and climbing, that's a lot of sheep. That's a lot of sheep, which means you're going to need something big to scare those sheep away. So does it have more to go? I don't know. You once said not to invest time in reading books on investing. Why? Well, usually you're not going to be told very much. Listen, here's the thing. let's say that I had this algorithm and this technique that was generating 40% returns because I found some inefficiency. The last thing I'm going to do is tell you about it. That is the last thing I'm going to do, because if I tell people about it, that inefficiency goes away. I'm not telling anybody about this. This is mine. I'm keeping it to myself. I'm not sharing it. Screw you. Go get your own gold, right? When it no longer works anymore, and I've got a name for myself because I made all this money with this technique I had, now I'm going to write a book and tell you about it. Because it's the last trade. You are the last trade. If I'm opening a website and saying, okay, listen, we got these proprietary tools that trade Forex, come on in. Why would I do that? If I'm making the money I claim to make, well, what do I need to waste my time trying to sell it to you for? I will use it myself. Anybody who's making money with their technique, you've never heard of, you're not going to hear of, they're not going to tell you, they're not going to write a book. It's a guarded secret until it doesn't work anymore. Then they'll tell you. Because that's the last way to make money, is to tell you something that no longer works. The more I listen to Howard Marks, the more I feel he resonates with you. I really like his thoughts. Yeah. If someone is not good at educational background, like he is not from a good university, Howard Marks? University of Chicago? But as a wealth of experience, will you, you're talking generically now. Will you listen to him about investment decisions? Yeah, sure, I would. If he's made a name for himself, if there's somebody out there that's actually made a name for themselves, sure, I would. For CFA prep, you once gave advice that first read questions and go to readings or videos. Any other advices you have? Well, yeah, I'll pass on that one. That could take hours, and it's not specific enough. I will say, when you ask, and this is for everybody, when you ask questions, big, broad questions really have no answers, or I have to guess at what part of the big, broad field you want your answer to come from. So to say to me, what do you think of gravity? Or, hey, what are your thoughts on space? I mean, they're such big questions. Any advice for learning? Well, yeah, lots, but what specifically, right? Because you're not going to start from the beginning and hold a 3-hour seminar for one answer. So try to be as specific as possible. Do you advise to read research papers? Are they useful at all? Well, it depends on whose research you're reading. Pure academics, don't waste your time. I mean, there might be, in every field, there might be 1 or 2 A journals. And if you're going to read research, stick with the 1 or 2 or 3 A journals, and that's it. Like, every field has 50 to 100 to 200 journals. So take something like, management or finance. There's like 200 journals, 300 journals, academic journals for each of those fields. Of the 200, 195 of them you can just throw away. You can really just get rid of them. There's only maybe 3, 4, 5 that matter, and that's about it. There are some journals that are just academic and some that are practitioner. The practitioner ones are interesting. The academic ones are less interesting. People who are publishing are just continuing or just confirming the same study over and over again. Yep, another brick in the wall, right? This variable has been researched in this decade, in this decade, in this decade, in this geography, in this geography, but it has not been researched in this decade, in this geography. Well, there we go. There's my brick in the wall, right? There's my contribution to the literature, is that what's new? Well, it hasn't been done this decade in Canada, with Canadian data, right? And then you do it and you say, oh, look at this, I found the same thing that everyone else found. But you have a contribution now because some part of it is brand new. Does the market always run on fundamentals and how mass psychology works? That's again, that's a seminar. That's not a question I can answer. Does it always run on fundamentals? Nope. How does mass psychology work? Exactly that way. It's mass psychology. That's too big. That's a book. That's a book, right? For whom are you building your wealth for? For yourself or your kids? I don't have kids. Long duration with TLT. Market is against me for the last few days. Is this part of the game we play? Yes, it is. Should I be panicked and close my position considering my... I'm not talking anybody off a fence, man. I'm not even going to even answer that one. Will you buy a Tesla or buy the car and go long shares? No, I'll just buy a Tesla. If again, I'll explain it. If a single privately owned car takes one single ride without a driver in it and earns one single dollar as a robo-taxi vehicle, before the end of 2025, I will buy a Tesla vehicle. And my prediction is I will not be a Tesla owner because the condition I just set up is an impossibility. That a privately owned Tesla running a level 2 piece of software is never going to be allowed to leave is never going to be on any platform that allows it to leave its driveway on its own, pick up a fare, deliver it, and drive back. Never gonna happen by the end of 2025. So it's an empty promise. It's like saying, if a fat guy in a red suit on December 24th actually comes down my chimney, I will buy kids for the whole village. Well, I'll never buy kids toys for the whole village because that will never happen. I've set up an impossibility, so it won't happen. Out of curiosity, which Tesla would you buy? I'm not even going that far because I'm not going to have to buy one. I'm not shopping around and comparing features on these. I won't have to buy it. That's how absolutely certain I am that this million robo-taxi fleet is never going to happen. While watching the videos, I thought back to a Berkshire meeting in which someone asked about doing discounted cash flows to make investment decisions. Munger mentioned he'd never seen Buffett actually do one. I don't do them either. Gave a response to a lot of wisdom saying if you need to do discounted cash flow to calculate the value of a company, determine whether or not it's worth buying, you don't have enough margin of safety. So, there's a difference between Berkshire Hathaway and a fund with the S&P 500 as a benchmark. Berkshire Hathaway doesn't have a benchmark, and they buy companies and they buy stock where the price is going to go up. There are a lot of funds out there that have a benchmark, and they have to find shares of stocks that will outperform the benchmark if they hope to outperform the benchmark, because they have to invest to a benchmark. So it may matter for them. I don't do it because I'm not trying to beat a benchmark. If all I had was the S&P 500 and I couldn't go outside of the S&P 500 and I had other people's money under management and I had to beat that index, yeah, I would pay attention to any advantage I can get. Any small advantage I can get, I would be paying attention to. I don't do discounted cash flow at all. But if you're going into the finance industry, if you're going to get a job somewhere as an analyst or as an asset manager, you're going to be dealing with models at some point. So you may as well learn it. This is not for the retail investor. For the retail investor, I wouldn't even bother with discounted cash flow. Right now, all we're doing is a 5-year forecast. We haven't gotten into valuation, which is the discounted cash flow. What it does is it uncovers all the assumptions that you need to make. It uncovers all of that so that you're aware of all of the things that have to happen. Your assumptions on for Costco here, on the expansion in terms of how many warehouses are you building per year. What is the growth in your membership base? What is the growth in the executive penetration rate of your members? What is the growth in merchandise revenue per year? And what does that filter down to on the income statement in terms of, let's say, free cash flow or earnings per share, so you can do a quick comparative valuation. In doing that, you are aware of what is driving Costco's success. It helps you really get in touch with the company. But I don't do discounted cash flows at all. Unless an employer actually starts to ask for evidence of completing the applied series, I probably won't sit for a 300, 700 exam. I don't blame you. I agree with that statement. But if you're going to have an exam, that is the cost, because you have to have it hosted by someone who can proctor it. Unless you have the skill set and the technology to do it yourself, you have to have somebody administer the exam. You have to have an external audit on the exam. You can't do it yourself, otherwise it lacks validity. And if you're going to have written material, well, you're going to get a publisher to actually do it for you, other authors to write it for you. You're not going to spend the time doing that. It's just too much. It's a lot of work to get done. So yeah, the cost of these things for accreditation, for serious accreditation, the cost is in the accreditation, not so much in the knowledge, but in the accreditation. I agree. When I look at the price of putting one of these things together, I think but that's too expensive. Why not just, deal with certificates of completion? But if a window opens up somewhere where I can see getting it done at a cheaper price, I will, while not losing validity. But until then, I looked at some rando condos in Telluride. They cost like $1,500 per square foot. That's more than Yorkville, Toronto price. Well, it is a mountain. It is a ski resort, right? Saw one video of Howard Marks. He said, sometimes you don't have to beat the market, but if I take the point of view of asset management, is it not their job to beat the market always? Well, his thought is, you can get the market return in all cycles, right? What he's saying is it's good enough to get the market returns if you don't have the market losses, right? That you don't have to beat the market. You just have to not suffer the market losses. If you can avoid these, that's sort of his thinking is, it's very difficult to beat a market because your returns end up being part of the market itself. So it is difficult to beat the market, but if you can get the market in good times, but avoid the market in bad times, that's great. And sort of his thinking is, let's just, avoid this stuff. So if the market's up 20%, let's be up 20%. If the market's down 20%, let's be down 10%. And that cumulatively over time leads to huge outperformance by outperforming the downdrafts, not necessarily outperforming the updrafts. Let's say you really need a new iPhone because it has slowed down and you make $12,000. This question again? I get this question. This is the third or fourth time I get this question. I'm going to pass on that because I have answered that question already. Can we make it a rule for ourselves that okay, I've answered that. Okay, let's just move on. Curious in regards to your answer, one of the questions QA last week sent around overweight exposure of tech stocks. 20-year-old due to outsized beta exposure. Big setup here. It seems to be in stark contrast with models such as FAMA French 3 and 5 factor. Well, okay, so I'm going to stop there. No matter what I say is going to be in contrast to something else. Well, you should be diversified. Well, that's in contrast to what Warren Buffett says at Berkshire Hathaway. Well, then you should be, more concentrated. Well, that's in contrast to all the theories of diversification. Everything's in contrast to everything else. That's the point of a complex system, is you will have theories on both sides of the argument because, again, there is no solution for this problem. There are only trade-offs. You can be more concentrated, but diversification says it's bad. You can be more diversified, but those who have made a good living on concentration say that's bad. So you're going to point out some inconsistency based on some other theory. Sorry. That's what you get in complex systems. Let's just read a bit, make sure there's nothing else here. It seems to be in stark contrast with models such as FAMA, French 3 and 5 essentially have as the outperforming factor relative to growth. 5-factor models that essentially have value as the outperforming factor relative to growth. Okay, there's one, but the momentum is the big one that beats everything. Understand theory, heavier tilt to a market beta should increase your level of expected returns, but I can't seem to understand how something like tech stocks, which have a tendency to tilt, well, so here's the difference in that, and academics, right? You gotta think this through. XLK is a rebalancing portfolio, so it rebalances over time. Losers leave, winners come in. Here's a value stock, here's a growth stock. The value stock will do this. The growth stock will do this. Right? Over time, the value stock will always win in the long run. The growth stock will be growthy for a while, then it disappears, and that's factored in. But if you have a portfolio, once it starts doing this, it's gone, other ones are added. A portfolio that is rebalanced on a regular basis will always keep the growthiness in there, right? When growth turns to value, it's kicked out and something else comes in. So XLK tends to be, when a company in the XLK or in the technology sector stops becoming growthy, there'll be another growth company that S&P will say, well, this one's out, this one's in. Components are kicked out of the S&P all the time, and new ones are added in all the time. So it has that aspect in it. If you put up a 20-year chart of XLK versus SPY, the XLK has outperformed SPY over that whole period of time. Value is in consumer staples, even in consumer discretionary. Put those up and look at XLK versus those. XLK beats them. You want to go even further, look at Triple Q. Triple Q beats it, without a problem over a period of time, because they are rebalancing portfolios. So that is in sharp contrast to what these models say. Again, there we go. I'm bringing something in as well. That's in contrast to this. Somebody else can come along and say, but there's data here that says that's wrong, and then somebody else can come and say, oh, but I got data that says your data that says that data's wrong. There's no shortage of data out there to support any theory you have in a complex system. No shortage. And there are many ways to make money. There is no one right way to make money. Much as there are many different ways to be a good person, there's no one right way to be a good person. So it's a matter of, I wouldn't hold on to these things too tightly and say, well, this is the way. Find your own way. These are ways of thinking about things that can help, sort of declutter the environment. But I can find 10 different people who use 10 completely different strategies, and they're all successful in the same market. Much as you can go to a lake and you can find people fishing in that lake, and you can find them using all different techniques, different types of lures, and they're catching fish. There is no one right way to do it. What do you do when synthetic and short cover call have different expiry date? For example, I have Oxy synthetic November plus 55 call, negative 55 put, but I sold 52.50 call with October expiry. Once assigned, I will have short Oxy and a large amount of cash. but I still own the November synthetic. True. Yep. Should I close the synthetic? And at the same time buy back the, okay, I don't want to get into advice. I really, I really want to avoid that altogether. I don't know anything about you. I don't know anything about your portfolio. You know, I would just be doing a gunshot answer that is not tailored for anybody in particular. If you ask me a question, what do you think about Oxy? I'll tell you. But if you say, here's what I'm doing to the trade, I got this position, that position, what should I do? I'm not going to answer those questions. I'm not here for that, and I really do want to avoid all of that stuff. Of you know, I want no, just a short answer. I want nothing to do with any of that stuff. If the questions are just going to fill up with, you know, I'm losing money on this, what should I do? I'm going to stop answering. I'm not an advisor. I'm an educator. I'm not an advisor. I'm not here to look at your specific positions and talk you through something. I don't want that responsibility because there's no upside for me on that. There's only downside. Because it either has to work out, and if it works out, you did a good job. If it doesn't work out, it's because I gave you bad advice, right? That's usually how it works out. So I will pass on any question that asks me, what do you think of my position? Here's where I am. How do I get out? You got to do what's right for you. Oftentimes, what is right for you is to not do what you did to begin with. Right? Don't expose yourself. How about this? Whenever you take a position in anything, I want you to imagine the worst case scenario. What's the worst case scenario, and are you okay with it? So when I sell puts on something, and I'll draw it out for you, the price will either go up or it'll go down. If it goes up, I make money. If it goes down, it's going to be put to me. Right? Well, ABC. What if I don't want ABC? I sell a put on ABC. I don't want to own ABC. I think, what's the worst outcome? It'll be put to me. Can I live with that? Not really. I don't want ABC. So I would never do that because I can't live with the outcome. But TLT, I'm going to sell puts at 92. In a month, I'll either make that money or it'll be put to me. Are you good with it being put to you? Yeah. At 92? Yeah, I'm fine. I win, I win. Heads I win, tails I win. So I construct an outcome over which I am indifferent, that if it did fall to 92, thank you very much, I'll take it. And if it goes up, I'd probably be more upset that I didn't do more, if anything. But I want you to imagine the worst possible outcome, and this is a good technique to follow in almost any decision you make. What's the worst possible outcome? Or what is an outcome that you would find unacceptable, and is that a possibility based on the setup that you have? So you have a synthetic at 55, you sold a mismatched call at 52.50 for October. Worst case scenario, it gets called away from you, you have a short position. Can you live with that? And if the answer is no, then you shouldn't have done that to begin with. If you can live with the worst case outcome, then you never need to ask me, what do I do now? Because you can live with it, right? You opened up a window which exposed you to the potential to be short the stock because you had a naked call. And that would mean that you would have to exit. Well, you can't exercise your put. You're short the put. If the price falls, well then okay. If the price increases, it will either be called away from you, or in November it will be put to you at 55, which will then cover your short position. So if you think it through like that, you say, am I comfortable being short Oxy for a whole month? Yeah, I guess so. I don't mind. Let me check the borrow rate. How much is it going to cost me to be short? Does it have a dividend during that period of time? Because I'll have to pay the dividend. And if the borrow rate is really cheap and it doesn't have a dividend over that period of time, you might say, okay, worst case scenario, I'm going to be short for a month Because if it goes above 55, it gets called away. If it's below 55, it'll be put to me because I am short the put, and I'll cover my short position. I'm okay with that as well. Are you okay with those? Think about your worst case scenario in any trade that you make. You buy a stock for $60. Think about the worst case scenario. If it's a good value company trading at a low multiple, you might say, well, if it sells off, maybe it sells down to 55 or maybe even 50, right? Or maybe you say, well, I'm going to buy it and I'm going to put a 15% stop loss on this, so if it gets to 51, I'm out. What's your worst case scenario? I lose $9. Are you comfortable losing $9? No, then don't do it. Find another way to do it, right? As long as you're comfortable with the outcome. I can tell you this right now. Not everything you do is going to work out. You are going to make mistakes, and the market will not give you what you hope that you're going to get all the time. Nobody has a 100% track record, even on an annual basis. Very few people, I think, I'd say almost no one has a 100% track record on an annual basis that plays the game. You're going to have a loser in there. So you have to think about risk. Am I comfortable with the worst case outcome? Been investing in the markets in 2019, started the CFA program 2022, recently begun the applied level. Early in my investment journey, my decision making was quite juvenile, but I feel it has improved over time. Benchmark CAGR is 20%. Well, my returns are currently at 16. That's not bad. Want to know if I'm underperforming as part of the learning curve? Yeah. Or if I should consider moving to a more passive strategy. I'm really focused on, well, 20% is a pretty high benchmark. That's a pretty high benchmark. 16% is pretty good. I would be cautious about setting a return benchmark. I would set a process benchmark that you're going to follow. You're going to have rules and you're going to follow your rules, and that's your benchmark. And if you do that, the returns will take care of themselves. You can't control return, but you can control risk. And so you should focus on what you can control. UST rates do end up approaching zero. Wouldn't that result in US Treasury demand declining significantly on any new Treasury issue? No. Banks must hold bonds. Insurance companies must hold bonds. Prime dealers must hold bonds. Bond funds must hold bonds. No. Other central banks that hold US dollars, they don't just sit on a shelf somewhere. They sit in bonds. Whatever that return is, they must hold bonds. So no. And if it's the case that you can't find a buyer, do what the Bank of Japan does, be the buyer. They'll just be the buyer. The Fed will just be the buyer. So no. Could you elaborate on the idea of allowing home builders to borrow at the risk-free rate of some sort to boost new home construction? Any reason this wouldn't help ease the supply issues of the housing market? No. It would definitely help ease the supply. That you can give them interest-free loans only if they build spec houses, not if they're building a house. A house that's built to a sale, sorry, you don't qualify for financing. You got a sale. But if you're going to build 50 homes with right now, with no buyers showing up at this point in time, we'll give you an interest-free loan. That would just increase the supply of housing if you want to solve the housing problem. You can manufacture U.S. dollars using options. Can you explain how to do this using IB? Sell a put. It expires, I get US dollars. Find a US stock, sell a put, it expires, and it's not put to you. I now have US dollars in my account. That's all. That's all. Government debt on higher rates will make the debt worse. Yep. Since the US is rolling over its debt or issuing more debt to pay off existing debt, will rates need to be somewhat elevated to compensate investors for additional risk? Nope. Thinking long-term, I'm also curious on how countries move away from the dollar will impact foreign capital inflows to finance the debt. That wouldn't happen anyways. No, I don't see any of that as being a problem. How can I say that? How can I say that investors won't demand more interest rate, a higher interest rate, because there's more debt. The level of debt is not a problem. The level of debt is never a problem. They can go to 500% of GDP and interest rates at 0%, and there wouldn't be a problem. No debt crisis was ever caused by too much debt. All debt crises are called by a lack of confidence that the debt will be paid back. So as long as the U.S. can maintain the full faith and credit of the government backing the debt, as long as every investor says, oh, I'm getting my money back 100%, I don't care, it would not matter. That's where interest rates start going up, is when the ability to repay the debt comes into question, not the level of the debt. If it were the level of the debt, Japan would not have that much debt relative to their GDP. They would have been stopped a long time ago. But there is no concern that Japan can pay back its debt. No concern. So okay, as long as there's no default concern, it is risk-free. It is default risk-free. So as long as the U.S. can keep that up and investors feel 100% certain they're getting their money back, there'll be no debt crisis regardless of how high the level of debt goes. But the interest rate, for the affordability of it, will have to go to zero. Now, given that, there is no end. There is no end to the level of debt, which means there will be no end to the level of debt, because unless you use deficit spending, you're not getting elected. And it's about me. It's about me getting power. It's not about what's right for the country. It's about me. And by the way, you're all just too stupid to realize this anyways. So I'm going to promise you something, and you something, and you something, and everybody gets something if I'm elected, and you're all too stupid to recognize that I'm destroying the country. But in the meantime, it's about me. That's politics today. How about Fortinet for the other cybersecurity company? Well, they're big. They're number 2. Palo Alto is the biggest, and they have acquisitions in their past, which in the future, that's going to be a big deal in this space, is acquisitions. So usually you want to go with the biggest or the second biggest in the space. Fortinet is the second biggest. Yeah, I can see going with them. They're interesting. I've looked at them. But what you find in their statements, in their 10K very early, is this line, is we are not profitable, nor do we foresee being profitable, or do we expect to be profitable for the foreseeable future. Where do you go with that? We're not profitable, and we don't expect it for the foreseeable future. So you have to start looking at these companies a little bit differently. You can't look at them based on earnings. And it's sort of an accounting thing where they do lose money. And they will lose money for quite some time on an accounting basis. So if you look at their equity, a lot of them have accumulated deficits in their retained earnings because of the way it's done with GAAP. But Fortinet buys back shares every year. How is it possible an unprofitable company can buy back shares, right? Well, for that, you will have to tune in to the cybersecurity video that will be up in as soon as I get home. Give me 2 weeks after I get back to Canada on the 13th, 20th. By the end of October, I should have it up. And you'll have to tune in and see how that's done. Gravity in the markets is strengthening, and even though the stock market is building its potential energy by continuing to climb, it will eventually fall off a cliff after a kick due to historically rich U.S. multiples. Markets have never died because of overvaluation. Never. Markets have never died because of valuations. They die because of something else. Interest rates near local max? I don't think so. High probability of wider and deeper conflict. Number 3, if you're going to find something, you need a catalyst. Markets don't die of old age. Markets don't die of overvaluation. You need a catalyst to get that done. So yeah. Number 3, since money can flow to safety with reasonable returns, or even China at non-demanding valuations, High volatility event in the near future looks more probable than not. Long duration, overweight China, underweight US appears to be the optimal allocation. Thoughts? Well, I would take China out of it. I am long duration. I don't know about being underweight US. If you're long duration, you don't have to be underweight US, because if there is something that takes the US equity market down, it's going to take interest rates down really fast. Your duration wins. You know, you're trying to win on every security in your portfolio. It's not going to happen. That's how you introduce even more volatility in your portfolio. But if you have a portfolio where you say, well, if this event happens, this part of my portfolio should do really well, this part will pull back. That's how you reduce the volatility of your portfolio. Manage risk, return will take care of itself. A couple more here, I think. Mention that there's should be no difference between the Treasury's mix of issuing bills over notes, bonds. Rubini had a paper on activist Treasury issuance from July of this year arguing that there is a difference, that the Treasury can tighten, loosen credit conditions by their mix of issuance. And I can probably find you another paper that says, nope, he's wrong. Right, again, I don't know what he's thinking. So, reasoning being that increasing the issuance of bonds tightens credit conditions. Higher supply of long-term bonds lowers the price and increases long-term rates. Issuing more bills doesn't have the same effect because there's almost unlimited demand for bills from money market funds and investors holding cash. By decreasing the mix of bond issuance over bills, the Treasury is working against the Fed tightening. The Treasury will do what it does. The Fed will do what it does. The Fed has interest rates high. If I'm running the Treasury, I say, well, I can lock in a really high interest rate on a 10-year, but I know the Fed's going to be decreasing rates, so I can move some of my lending, government lending, to the short end of the curve where I'll pay a little bit more over the next 3 to 6 months, but I'll wait for the 10-year or the 30-year to drop, and then I will then start issuing at the 30-year at a lower price. I got a job to do at the Treasury. I got to manage the blended interest rate and the cost of the debt. And right now it makes sense to move to the short end of the curve, right? So I think he's attributing some motivation to the Treasury doing what it's doing that isn't there, simply because it's leaving that kind of footprint, right? So it's, no, I would disagree with that. I would say, well, if we think about the Treasury as doing the best job they possibly can in managing the cost and managing the issuance of this, if you knew that rates were going to come down, would you tend to lend your, borrow money for short periods of time before you lock in a long rate? It would be like saying, well, all these homeowners, these home buyers who are taking variable rate mortgages instead of taking fixed rate mortgages, if they were taking fixed rate mortgages, the demand for mortgages would increase and it would lower the rate. They're keeping rates purposely high. No, they're not. They're taking a floating rate because they know they can get a lower, longer term rate later on. They're not even thinking, you know what I'm going to do? I'm going to fuck it all up. I'm going to do this and screw it all up. No, that's not what's going on. That's not what's going on. So I would disagree with that 100%. God, you give a guy a Nobel Prize once, they think they know everything, right? Did you watch GM's Investor Day on Tuesday? Well, the one thing you got to like about their Investor Day is, well, a couple of things. Number one, that they're going to change the chemistry on their batteries to lower the cost. They're going to move away from having just the Ultium platform. And the big thing, they're just going to keep buying back shares. They said as much. They're going to keep buying back shares. Positive guidance for the end of 25, so strong earnings report at the end of October. Does this increase your conviction of GM reaffirm 70-80 per share price? Getting there, probably on a lot of share buybacks. But yeah, but when? I don't know. So, if there is a downturn in the economy, their free cash flow will drop. It is sometimes not uncommon to have negative free cash flow in the auto industry, which means share buybacks wouldn't happen at that point anyways, not without more debt issuance. So I would be cautious going into the second half of 2025. I'd just be cautious. Couple more, and well, how many more do I got here? Oh, quite a bit more. Okay. Would you close all TLT? No. I don't even have to read the rest of it. The answer is just no. Do you read the FOMC beige book? Not really. Not really. Is it correct to calculate long-term inflation expectations by subtracting the 30-year real yield from the nominal yield? Well, that is what I do. That's exactly what it is. Yeah, that's exactly what it is. I don't know what the rest is, but since I answered the first part, I'm sure that the other two will fall into place. 10-year government treasury yield 4%. Does this mean the market is pricing in 200 basis points of rate cuts in 10 years? No. You can only use that on the short end of the curve, like the 1 month, the 2 month, the 3 month, maybe the 1 year, maybe the 2 year. But once you get out to the 10 and you have that kind of duration, you have that many, you have all those coupons in there. No, you have a combination of, well, it's semi-annually. You have a combination of 20 spot rates. You can't make that calculation. Can you please explain curvature? It's not a big deal. I wouldn't worry about it. If you've not come across a measure of curvature before, don't worry about it. It's for the CFA candidates out there, they'll understand curvature. It's not a big deal. It really is not a big deal. I'm not trying to brush it away. It's just not a big deal. For bond returns, 90% of all bond returns come from duration, come from changes in levels. About 7%, 7 to 8% come from changes in slope, steepness versus flatness, and a very small part of the return comes from change in curvature. So I would just ignore it. Calculate my portfolio's theta. Then I checked IB analytical tools on the Risk Navigator and found that the total portfolio theta is 14. I assume that if systematic risk occurs, the available cash in my account would be enough to cover all the put options assigned to me. I don't know what you're selling puts on. I don't know. How can I increase theta from 14 closer to 50 while considering systematic risk? Use utilities. Utilities and staples, they hold up well. When the market turns down, those sectors hold up very well. So they're nice and safe to sell puts on. Selling puts is not, it's not a matter of I want more theta, I should sell more puts. The biggest. So let's say that here is the task that you have to do. I'm going to say 90%. 10% is the actual selling of the put. 90% is choose the right underlying. You have to select the right underlyings. If you get that wrong, this whole thing will blow up in your face every time the market turns around. You got to spend the time choosing the right underlyings. Mark stands next to a new Tesla. Yeah. Real rates and nominal rates. Nominal rates, real rates have no inflation component. And if you take real rates plus the inflation expectation, you'll get to a nominal rate. How can I play a larger rate cut by the Bank of Canada with Canadian stocks, options, anything other than REITs? Utilities, Canadian banks. Economic calendar. One more, I'll talk about a debt jubilee, debt cancel it. That'll never happen. Never happen. Doesn't sound, I already answered that one. CPI. What would your strategy on that day be if CPI is higher than, and if CPI were lower? I don't know. You tell me. It's not a matter of what my strategy would be. It's what's moving, what went up and what went down. Then I would decide. You could, this market is weird. Sometimes you get data where you think, oh, well, the market's going to be down, and it just rockets straight up, and you think, what am I missing? And there are other times where something happens, you think, oh, bonds are going to suffer. But no, bonds are doing fantastic. It's like, well, what am I missing here? So, I don't know what I would do or what my strategy would be. If it comes in low or it comes in high, who the hell knows what's going to happen? CPI could come in flat, like zero, showing no inflation. Market sells off 100 points. You're left scratching your head, going, "Well, I don't quite get that. What's the calculus here? How do we get there?" But there'd be something for me to do, which would be different than if the market went up 100 points. So it's not what the report says that's important. It's the market reaction to what the report says that will be important. I have no idea what the market reaction will be. Fed keeping rates low over the mid to long term due to our debt burden. You mentioned inflation as another component, hoping to inflate away the debt. Would you elaborate on the effect that keeping rates low with higher inflation would have on national debt? Well, higher inflation means higher nominal GDP, which means higher tax revenues, which means better ability to pay back depreciating dollars, right? How likely is the federal government going to pursue this plan? There's no choice. Politics today, democracy today, will leave central banks with no choice unless politics returns to the 1960s, 1970s style of responsible government, even 80s, 90s, responsible government, instead of this social media, TikTok, Twitter type government we have now. This is a one-way street. This is a one-way street. So, I don't really care how the country destroys itself. All I care about is how do I make money on the way to that destruction. Okay, I'm back. You probably didn't notice, but I was gone for 20 minutes. I had to pick up the staff. It is 6:58 a.m. here as I do this. I don't think we have much to go here. Do you recall any other prominent CEOs that align themselves with a particular party? I seem to think Elon's gamble of going all in on MAGA will hurt him in the long run. Demographic is difficult, and I think impossible to sway over to EVs no matter how conservative Elon acts. CEOs normally stay out of this thing because they want to be able to work with any administration. So it's they usually just stay out of it. But Silicon Valley CEOs do take sides. Historically, I don't think I ever recall a CEO lining up behind anything. Labor tends to. But no, CEOs for the most part usually stay out of things. Other car companies are playing catch up, will continue to build a diverse portfolio of vehicle types. They aren't showing political favorites and should continue to capture more market share. They already are. Best move for Tesla might be to shore up some cash and diversify their vehicle lineup either through an acquisition or hybrid alternative. I said they should buy GM. Yeah. Let's see. I think you'll continue to get how should I study questions. New generation of college students during and since the pandemic who half-assed their way through their undergraduate degrees, and it worked because online classes lowered the standard and online work makes it much easier to cheat. Not to mention the university business is getting harder, so acceptance rates are going up. Many business majors come out of school with no confidence that they've discovered what study habits are most effective for them. I think that's always been true of a certain portion of the university population anyways. I know when I was going to university, just in residence, just on the floor, you could tell which people were there, and you wondered, what are you even here for? Like, you're not doing anything. Every time you get grades or whatever, they're pretty pathetic. What are you even doing here? And so I think that's always true, that there are some people who bumble their way through and probably when it comes time to actually do something, maybe have no idea how to do it right. Maybe that's true. Yeah. This report seems more cooked than a Texas smoked brisket. What report? I don't know what you're referring to. You didn't leave a timestamp, so I don't know what. Or you heard that line somewhere and you've been dying to use it, so you used it in the context where it doesn't make sense. I don't know which one. And then I got a bunch of timestamps of which I'm not gonna check out. So there we are. I know that some of my answers were unsatisfying, but anything that relates to the future and what's going to happen, I don't know. Nobody knows. All we can do is have our best judgment and make sure that our portfolio is set up such that, well, what if our best judgment is wrong and something else happens? Well, then this stuff will work out, or this stuff will work out. So some diversification across factors is important, and yeah, I guess that would be the takeaway from this one, is that whenever we're talking about the future and asking me what's going to happen, or questions that lean towards what the future will look like, nobody knows. Truly, nobody knows.